Imagine it's February 2026. You're a mid-level analyst at the United States Department of the Treasury, working inside the Office of Debt Management, 3 floors underground in Washington, D.C. Your job isn't to debate whether America should borrow money. That decision was made decades ago. Your job is operational. How much do we borrow this week? At what maturity? At what yield? How do we make the auctions clear? This morning, you're staring at a maturity schedule that doesn't look dramatic to anyone outside the building. But if you understand sovereign finance, it should make your stomach tighten. Roughly $9.2 trillion in Treasury securities will mature over the next 14 months. Those bonds don't roll themselves. The holders expect their principal back. The government either pays them with tax revenue it doesn't have, or, as it has done for generations, it issues new debt to pay off the old debt. It rolls it over. But the old bonds were issued between 2020 and 2022, when rates were near zero. Many carried coupons between 0% and 1%. The new bonds replacing them carry rates closer to 4.5% to 5.5%. You are refinancing the most indebted sovereign in human history at interest rates 4 to 5 times higher than what it was paying before, and almost no one outside that room understands what that implies. This isn't speculation. The bonds already exist. The maturity dates are fixed. The higher rates are already here. This isn't a story about what might break. It's about a system that already cracked. It just hasn't made a loud sound yet. When most people hear that U.S. federal debt has surpassed $36 trillion, they register that it's large and move on. The number has been big for so long it feels abstract. Background noise, a talking point in campaigns that disappears after elections. But the real danger was never the size of the debt. It was the cost of servicing it. And in 2025, that cost crossed into territory with no easy exit. Between 2008 and 2021, the U.S. government operated under the most favorable borrowing conditions in modern financial history. After the global financial crisis, the Federal Reserve slashed interest rates to near zero. They stayed there, with brief interruptions, for more than a decade. During that period, the Treasury borrowed aggressively. Debt rose from roughly $10 trillion in 2008 to over $31 trillion by 2022. Yet interest costs stayed relatively contained. In 2015, net interest payments were around $223 billion on about $18 trillion in debt. By 2021, interest was roughly $352 billion on nearly $29 trillion. The debt grew massively, but because the average rate fell from around 2.4% to roughly 1.6%, the system appeared stable. Cheap money masked structural risk. Then inflation returned. In March 2022, inflation surged above 8%. The Federal Reserve began the fastest tightening cycle since the early 1980s under Paul Volcker. By mid-2023, policy rates were above 5%. And here's where the maturity wall becomes decisive. U.S. debt isn't a single loan. It's a constantly rotating portfolio. 30-year bonds, 10-year notes, 2-year notes, and a large amount of Treasury bills that mature in a year or less. During the low-rate era, the Treasury leaned heavily into short-term debt. It was cheaper. Why lock in 30 years at 2% when you could borrow for 3 months at near zero? It made sense then. But short-term borrowing means frequent refinancing. When rates jump from near zero to above 5%, every rollover becomes more expensive. Not because of incompetence, not because of a scandal, because of arithmetic. Old cheap debt matures. New expensive debt replaces it. The blended rate rises. The interest bill compounds. In fiscal year 2023, net interest was around $659 billion. In 2024, it surged past $880 billion. Projections show it crossing $1 trillion annually by 2026. That would exceed the defense budget. It would rival or surpass Medicare. It would be larger than the entire federal budget was in 1987, and it buys nothing. No infrastructure, no research, no healthcare. It is payment for past spending. A key metric in sovereign finance is the interest-to-revenue ratio, the share of government revenue devoted solely to interest. In the early 2000s, that ratio hovered around 8-9%. By 2024, it was pushing toward 20%. That means roughly 1 in every 5 tax dollars collected goes straight to bondholders. As long as new borrowing costs exceed old borrowing costs, that ratio rises structurally. The system has no automatic stabilizer to reverse it. When interest consumes a small portion of revenue, governments have flexibility. When it consumes a large share, flexibility vanishes. Borrowing shifts from funding investment to funding prior borrowing. This dynamic has appeared many times in history. Look at Greece in 2010. Debt levels were high but manageable until refinancing costs spiked. Yields on Greek bonds soared. Rollover became impossible, and the country required intervention from the European Central Bank and the International Monetary Fund. The result was severe austerity, wage cuts, pension reductions, and a deep contraction. The United States is not Greece. It issues debt in its own currency. It has the Federal Reserve. The dollar remains the world's primary reserve currency. But structural advantages don't eliminate constraints. They alter how those constraints express themselves. At a high level, there are 4 paths when debt servicing becomes dominant. 1. Cut spending dramatically. But Social Security, Medicare, Medicaid, defense, and interest make up the overwhelming majority of spending. Eliminating all discretionary programs wouldn't close the deficit. Deep cuts would be politically explosive. 2. Raise taxes dramatically. That would require lifting federal revenue to levels not sustained in modern peacetime America. Politically feasible in theory. Practically fragile. 3. Financial repression. Allow inflation to run above interest rates, gradually eroding the real value of debt. This happened after World War II. From 1946 onward, moderate inflation and controlled rates reduced the debt burden over decades. Savers paid the hidden cost. 4. Monetization. The central bank purchases government debt at scale, expanding its balance sheet. This is more inflationary and risks currency credibility if pushed too far. In practice, modern systems often blend the third and fourth paths incrementally rather than announcing them. Meanwhile, other structural pressures converge. The Social Security Trust Fund faces depletion within the next decade. Corporate America also faces refinancing at higher rates. Commercial real estate loans mature into a post-pandemic office market with elevated vacancies. Regional banks hold exposure. The dollar's share of global reserves has gradually declined from earlier peaks. It remains dominant, but marginal erosion matters when trillions must be rolled. This is what makes the situation a trap. Cut rates too aggressively. Inflation risks reigniting. Keep rates high and interest costs climb faster. Extend maturities and you lock in higher yields for decades. Shorten maturities and rollover risk intensifies. Every lever carries trade-offs. History shows patterns. Carmen Reinhart and Kenneth Rogoff documented them across centuries. Borrow cheaply in stable times. Accumulate debt. Conditions shift. Servicing costs rise. Choices narrow to austerity, inflation, restructuring, or some combination. After World War II, the United States deleveraged successfully, but that era featured extraordinary tailwinds, unmatched industrial dominance, demographic expansion, Bretton Woods monetary architecture, rising productivity. Today's environment is different. Aging demographics, slower labor force growth, intensifying global competition, higher structural spending commitments. The debt must be managed in a world less forgiving than 1946. Some argue sovereign debt doesn't matter for a country that issues its own currency. Technically, the US can always create dollars to meet obligations. But technical solvency is not the same as preserving purchasing power. Between 2020 and 2024, cumulative inflation exceeded 20%. Real wages struggled to keep pace, especially for lower-income households. When currency purchasing power erodes, the default is economic rather than legal. Bondholders may be paid in full. Citizens may still experience declining real standards of living. By the latter half of this decade, interest payments are projected to become one of the largest line items in the federal budget. Unlike discretionary programs, they are automatic. Contractual, non-negotiable. In past debt scares, such as the 2011 downgrade by Standard & Poor's or the 2023 downgrade by Fitch Ratings, markets reacted calmly. U.S. Treasuries remained a safe haven. Monetary privilege can persist for a long time. But history shows it can shift more quickly than expected once confidence dynamics change. The likely resolution, if history is any guide, won't be a dramatic collapse. More likely is gradual constraint, slower growth, higher baseline inflation, reduced fiscal flexibility, a narrowing of policy options during future recessions or crises. Debt crises in advanced economies often resolve quietly through years of subtle adjustments that redistribute real wealth. The burden rarely falls evenly. This analysis is historical and educational, not financial advice. It examines patterns and structural dynamics rather than predicting specific outcomes. Back in that Treasury conference room, the analysts understand all of this. There is no secret document that solves the arithmetic, no hidden lever that resets the system without trade-offs. There is management, auction by auction, maturity by maturity, adjustments at the margin, hope that growth surprises to the upside, hope that inflation moderates without re-accelerating, hope that demand for treasuries remains durable. Hope fills the space where clean solutions do not exist. The refinancing wave does not announce itself with a single dramatic weekend. It manifests as a steady rise in interest expense, a steady narrowing of choices, a steady prioritization of past obligations over future investment. The bonds are already issued. The maturities are already set. The rates are already higher. The trajectory is driven by compounding arithmetic. The central question was never whether the bill would come due. It was always who ultimately bears the cost, and whether they recognize the pattern before the options narrow beyond reversal.